You've got to trust in the odds of success. Now, if we take this at a worst-case scenario, which would be a basic 50% probability of success, so you're going to have 50% winners and 50% losers. This is where money management comes into play. So if all we did was we went back and looked at every weekly high and every weekly low, and we said, okay, as soon as the market gets up to that price, I'm going to trade a 3-bar reversal. And that's all we did. And we assumed a 50-50 win-loss percentage. This is where you've got to make sure that you're not risking too much. For example, if you're going to place your stop here above the high, and again, my suggestion would not be to place it directly on the high. It would be to place it above the high. Also, making sure that you're watching out for any kind of even number stop over here. If you are going to place your stop up there, let me just clean this up here. So if you're trading here, so you're going short, you're placing your stop, you've got to have some sort of expectation for the market to move down. Now, anybody who's been listening to me for very long will know I like using logical points. Logical points are simply areas of consolidation or long-term or spike reversals. You can see there's a spike reversal here. So all of these areas in here are support, which equals the target. Now, it may or may not get there. You'll find that probably, again, people always want to know, well, how often does it get there? What are the probabilities? I don't know. I'd have to say better than 50% of the time. There's your answer. So if support is the target, and let me digress here for a minute. Because I've been on a couple of phone calls with some traders this week. One of them in particular, he's got a lot of experience designing systems, and he was talking about some of the trading tactics that I use and how it just didn't seem like statistically they would play out. And the comment that I made to him was, the thing that I have to say about statistics is this: every major fund or trader that I've ever known who is purely statistical, all he uses mathematical formulas, has blown up spectacularly. They've just lost a ton of money, in some cases billions of dollars. Now, it's not to say that using quants or quantitative theory or just trying to use math or statistics is bad. I'm saying if you're only relying on that, what you're missing out on is that the market is governed by people. And if you know people, you know that they're highly unpredictable and they're irrational most of the time. So why would you try and make rationality, if I can coin the phrase, out of something driven by irrationality? Okay? The marketplace at its core is irrational. It won't fit into long-term logical boxes. That's why for a long time the academic community has said that the market is completely random, it's governed by chaos, and there's no way that you can predict the market. Of course, the thousands of traders who make a ton of money at this sort of invalidate that theory. Nevertheless, that has been the theory, that the market cannot be predicted. And I would say to the contrary, it can be predicted as long as you're flexible. Okay, so enough of that. And at any rate, remember I was saying all that because everybody's going to want to know if it's going. How often does the market get to the support, or how often does it get to the target? I don't know. You just have to monitor the market. You've got to take from the market, what it gives you. So if we're going short here, and we're placing our stop up here, we've got a target somewhere in this zone. Okay, somewhere in this zone. We can then calculate what our profit and our stop is going to be. Okay, so let's just go ahead and use some numbers here. Let's place our